And on today's show, how to measure life insurance product expense cost. Part 2 of this week's series on life insurance for tax-free income with co-host and nationally recognized insurance product expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmouth. Let's get down to business. Hey, welcome to the show, day 2, Mike.
Great to be back.
Well, we're going to talk about some stuff today, and I'm glad you're back because I need you to help us walk through some of this. When we're looking at product costs, and we're doing a basic look today, we're not doing a really deep due diligence dive because our show's much more general in that regard. But let's talk about it. All financial products have some cost. The issue is the cost worth the benefit and so forth, and all those ideas and arguments out online that I hear all the time. Let's first take the first one right off the table. Let's talk about RIA fees. Mike, I've noticed that since 2008, those fees have come down.
There is significant compression with fees due to competition, just due to regulation, all those types of things. But again, I think you hit the nail on the head there. Is that advisor fee worth the extra return that I'm getting out of my portfolio versus a stated index as a comparable benchmark? Now,
I've noticed that when we're talking about RIA fees, if you took this to its, I would say its natural conclusion from a logical point of view, if I'm paying, and the average RIA fee in the United States right now is right around 100 basis points. But I get that 100 basis points whether I have a good year or a bad year, and I have that all the way out. If you took RIA fees under assets under management, and you looked at that number from the time the client becomes, or the advisor picks up the client and he retires and he's not involved any longer, that number is pretty substantial when you look at it overall, especially if you're going to stay with that RIA. Now, the reason I bring this up is just because I want to make sure that when I compare life insurance expenses to other product expenses, that I throw that in and say it is forever. If my index product or my par product or whatever, if it's going up every year, and if they're investing in side funds, their AUM charge is actually going up. It's 1%, but it's getting 1% of that asset.
Right.
So it's very critical to do the all-in due diligence. The second thing, fund expenses. Mike, we're talking about whether it's funds, ETFs, spiders, they all have expenses. These, even the cheapest Vanguard and some of the Fidelities, and they're very inexpensive, they have 60, 70 basis points. It's still 60, 70 basis points.
Yeah, 60, 70 basis points for an index that really is not getting actively managed. It's a very passive index. You take a look at one of the largest funds, and again, this kind of goes back to investor behavior as well, but Dalbar has stat after stat, year after year after year, where the fund actually returned 11%, but the average investor in one of the largest funds last year actually returned a negative 11 because of investor behavior getting in and out and transaction costs. So that, in combination with fund expenses and all the other things that go into operating a fund, you have to take a look at the total drag inside an investment versus a cash value life insurance and compare apples to apples with total cost of insurance and things like that.
The average fund expense, and remember, I'm taking a lot of this from the online, whether it's Morningstar or whatever. If we compare index only, it's going to be under 100. If I look at the normal fund across the board, we're at 100 basis points plus. So we're already at 200, maybe 210 basis points with RIA fees and fund expenses. But here's one thing, Mike, that is a real, I would have to say, this is one of those ongoing gripes that I've had all my life, and that is that the statement of additional information is not required by the RIA or advisor to hand to the client or the investor. Now, I've always found this to be odd because there's more. They say, most people say, there's my fee, my IRA fee, there's my fund expense, and they say that's what you're paying. But they're not paying that. They're paying additional.
All this other stuff, yeah.
Yes, and it could be as high as 90 to 110, depending upon the fund, 90 to an additional 110 basis points that nobody brings up. And the only way an investor can get that statement is to order it.
By request, correct.
Yeah, so talk a little bit, I mean, I don't want to get into the justice of it all, but I'm just adding to the numbers that people don't disclose.
Yeah, I think that a really good planner gives this as part of the prospectus, but the reality is there are a lot of costs associated with this actively managed mutual fund that go into operational, those types of things that can add anywhere from 75 to 125 basis in fees. So be mindful. Ask for that, and then get into the habit of getting out that statement of additional information to all of your clients.
Now, the only reason I put term life premium up here is because whatever I'm going to do on the life side of the equation, I use this as an expense on this side because I still have to pay term for term coverage. So I'm just trying to be a bit fair here by saying I have RIA fees, fund expenses, SAI fees, and then I also have the term. So I remember I'm buying the least amount on the life side of this equation. So whatever I'm doing, almost everybody's going to have some kind of a term policy close to that. And I always use the best term contract out there to exacerbate my argument. So I'm going to put that on there. But now let's bring up the big one. Federal, state, and Social Security benefit taxation. These three things, if you put this, and by the way, I don't know if we should argue, should I do this in percentages or should I do this all in basis points? Can you imagine putting federal and state taxes and Social Security on basis points instead of traditional percentages?
Yeah, it'd be confusing and scare a lot of people as well.
Those numbers would be so huge. And by the way, we dance in and out of these issues all the time. We talk about the tax bracket as a percentage, but we talk about these fees as basis points. And I think we need to come to some universal idea. But these are the expenses that we're looking at. And I just want to know, when's the break-even point?
Yeah, and one thing I want to jump in here as well with fund expenses, one of the things that we talk a lot about is what I refer to as the loser's tax. When you have an actively managed account, which is, comes into global, emerging markets, where there's a lot of turnover, when you take a look at some of the funds, I think one of the things you have to take a look at is turnover rate. Because if that fund is turning over more than 100%, they're going to have short-term capital gains, which are taxed at ordinary tax rates. So that's a hidden cost in there. You may say, hey, my share price went from $10 to $13 over X months, but the reality is they've got some embedded tax gain. And when you buy into a mutual fund, you're buying in to some already embedded taxes that you haven't participated in that gain. So there's some hidden costs associated with all these inside of these funds that need to be compared as well.
Remember, we've been disclosing our side of this equation ever since we invented universal life. So we've been doing this for almost 28 of my 30 years. All we're asking now is for us to see full disclosure on the funds for the length of time that I'm going to hold so I can make a fair comparison. Now, when we come back from the break, we're going to talk about the life insurance product costs and really give you an idea of why we need to walk through this as far as our argument. It's a really good discussion point and a great talking point for you and your client. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, my co-host Mike McGlothlin is with me. We're talking about the expense loads and the taxes, some of the things that are drags, fee drags, fund drags, some of the things we talked about in the first half is going to be revelation, because a lot of people always ask me, Steve, I didn't even know about this thing called the Statement of Information Fee. And you brought up a really huge point, the embedded tax. From the get-go, I'm already going to be behind the curve just by the way the fund operates. Unbelievable. Well, Mike, let's get the bad boy out of the way right away. The cost of insurance. This is the place where we get to play. As I've said before in our yesterday, we want to drop this death benefit as low as we can to comply with DEFRA and TAMRA. Cost of insurance is everything, and it's an issue. And remember, we're going to test guideline annual. We're going to test the CVAT. We're going to say male or female in the family. We're going to look at increasing. We're going to look at level. We want to know what the number is and come up with a really good cost of insurance. And remember, every chance I can lower this with the code, not only in design at the front end, but lowering it as I get out into the 13th, 14th year, even before retirement time. If I can do this according to the code, I want to lower the death benefit again. And a little side note, I always tell the carrier what I'm doing. Everybody never uses that memo. You go in the application, it says memo, anything else you want to add? I always add yes. I'm lowering this according to the step. Please look at my illustration cover, because that's not part of the policy. So I actually put it in the memo saying I'm dropping the death benefit and I'm switching the option if I'm doing it. And I put it in the memo to tell them so it becomes part of the contract. Premium lows. Now, there's a little debate here, Mike, whether there should be or not, but there's an expense here.
There's an expense. There's an expense to administer the policy. There's an expense to issue the policy, the whole ball of wax. I think when you combine and take a look at these two things, actually the first 3 or 4 things here, those are low impact type of dollar amounts. When you compare the alternative of taxation, of fees on a mutual fund, placement fees as well as ongoing 12B1 fees, those are minimal compared to the alternative is I think the point that we want to hammer home.
Yeah, and by the way, I want to be full disclosure on this. When I say to you, look, a premium load, if I'm putting in $10,000 a year, which is going to be some of our examples Friday show, when I'm looking at $10,000, I'm going to be paying about a 5% load for that. I'm not saying that's good or bad, it just is what it is. So when I'm paying that load plus the cost of insurance and so forth, I'm not going to be able to compare my fees against anybody else's fees in a fund for at least 8 years. We're going to lose on that issue. But remember, if you're into life insurance, you're doing it for the long haul. You're in it for a retirement plan. You shouldn't be looking at this unless you're really looking at a good 10 years out. Anything under that, I just think the liquidity issue after surrender charges and everything else, I just don't think it's going to work.
Yeah, one thing I want to point out here before we get too far away from cost of insurance is really probably about 50% of Americans are in the wrong rate class right now, negatively. So there's a great opportunity to go out and have a conversation, whether it be term or permanent, convert the term to some cash accumulation and improve the client's cost of insurance position because of medical technology advancements, longer life expectancies. We're able to help a lot of advisors help their clients lower that cost of insurance.
Now think about this, Mike. Traditionally, our industry has been very good about talking about policy audits, annual reviews. Now, I know of nobody, except for a few of our people, our sponsor, they really actually look at the life insurance for income side of this equation now. So we're actually, I think, one of the first ones actually diving deeply and finding out, oh, let's look at these costs. Maybe there's loan costs. Maybe the distribution isn't going to be correct. Maybe the death benefit. Maybe the medical. We need to relook at that. I think all those things are good. If you're going to do an audit, let's do it all, especially on the life insurance for income audit, which hardly anybody does. Now, talk a little bit about variable because, we got to talk about sub-accounts. We have all these costs and then the cost for the account.
Sure. Yeah. Just like we talked about in the first segment, you're still going to have management fees. You're still going to have some administrative fees inside of that. They are typically a little bit less expensive than a retail fund because of the critical mass that you get inside of a sub-account, and the distribution costs are less because they're going through an insurance carrier. But the reality is that those costs still are there, and they are there every year thereafter, and they are tied to the account value. So as the account value grows, which hopefully it will, then that hard dollar cost continues to grow. So you do have to manage from an expense standpoint and an overall asset allocation. And then also you just need to make sure, I want to say here, to go back and do that risk tolerance test that you talked on Monday and make sure that we're not taking undue risk, because a client never knows how much risk to take until they've taken too much.
Well, you brought up a huge point, Mike, and I want to drive it home. The expenses for the sub-account, I'm adding that layer of expense load on. I have to be assured that I have a good chance of beating a straight-up index product that doesn't have a cap on it. Now, again, most of our indices, nobody's paying a dividend. So I understand that, the comparisons are a little bit different, but I have to make sure that I can exceed the index. If I'm sitting there and the client says, I'm good with 12%, maybe I'm paying extra costs and extra beta risk.
Yeah, cost is only a problem in an absence of value. If that money manager is driving value, getting superior performance, we have no problems paying that particular 12B1 or that underlying cost. But when their value dips below indices, I think that we have to question whether it's worth having in the portfolio and worth having in the insurance policy.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, your legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our site, downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant for Mike McGlothlin. We'll see you tomorrow.